Ladies and gentlemen, welcome to the first episode of the Contrarian Investor Podcast. I'm Tom Wallace, and today I'm privileged to be joined on the line by an absolute legend in the natural resource investment world. Rick Rule is the President, Director and CEO of Sprott US Holdings, and as part of Sprott Incorporated employs over 130 professionals and has $8 billion of assets under management. Rick, on behalf of myself and my listeners, thank you for joining me today.
Delighted.
Rick, to kick off this interview, the first question I'd like to ask you is something that's probably on the lips of a fair few of my listeners. What is contrarian investing?
Two quotes about contrarian investing, which I think will sum it up for your listeners. The first is George Soros, who said, quote, I made my fortune by finding popularly held perceptions that were wrong and betting against them. The second is Warren Buffett, of course, who famously said that he made his fortune by being brave when others were afraid and afraid when others were brave. He also said that one buys straw hats in winter when people aren't afraid of excessive sunshine. A contrarian is someone who is forward-thinking and someone who understands that today's set of circumstances will be less true in the future than it is today. One who understands that expressed opinion is usually a representation of prior action, which means that if the sentiment associated with a sector is 80% positive, it means that the commentators have already expressed their preference in the market, and therefore any demand which you might expect has already been expressed. And that very optimism sows the seeds of its own decline.
What are some of the risks that the average mum and dad should be concerned about when it comes to investing?
There are so many risks that I would draw all your ma's and pa's out of the market if I enumerated all of them. But what I can say, for having served retail investors for 35 years, which I had, is that the predominant risk that every investor faces is easy to deal with because it's conveniently located. It's to the left of his or her right ear and to the right of his or her left ear. It's your own action or inaction that poses the most risk. Natural resource investors, as an example, want to be contrarians when it's popular, which is, of course, impossible. In 2010, when the market is overpriced and flying, everybody's brave because their recent experiences has been good. And your expectations of the future are set by your experiences in the immediate past. People's expectations last summer, when I suspect this bear market bottomed, were bad. And so people similarly didn't have the courage to enter the market despite the fact that the market was 75% less expensive, which is a different way of saying 75% less risky. So that's an example of being your own worst enemy in investing. Yep. Your government, be it in Australia or here in the United States, comes in a close second. The big thinkers of the world have us believing that short-term liquidity, that is cash in the system from quantitative easing, is a substitute for solvency. What we need to realize in your country and our country and every other developed country is that the promises that we have made to each other through the political process are unsustainable. We owe people my age, as an example, pensions and health care that are not going to be financeable by people your generation. You need to understand that we spent your inheritance, and you need to be mad about it. And you need to ignore the big thinkers, the Obamas and the Boehners and the Yellens of the world, who suggest to you in the first instance that liquidity is a substitute for solvency. That's a lie. Yeah. And you need to understand that this period of low interest rates is politically inspired. You are subsidizing spenders at the expense of savers and earners. It's a political transfer to a politically more numerous class that is very, very, very difficult to make work. One of the things that you need to understand is that when the markets prevail and the interest rates go up, that people who are involved in interest rate sensitive investments are going to get hurt. People who are over-leveraged are going to get hurt. They're going to get hurt because they paid attention to what's happening now as opposed to what's going to happen in the future. So I'd say that that's a very, very big risk indeed.
Rick, renowned contrarian economist and best-selling author Mr. Harry Dent has warned that the Australian property market is in a bubble, and when it bursts, we could possibly see prices decline by up to 50%. What are your thoughts on the Australian property market?
I'm not familiar enough with Australian markets to comment on that. I know that there's been a lot of incentive given by the federal government in Australia to housing starts and individual home ownership. But I don't know enough about the Australian markets in the context of rising incomes to comment on your property markets. What I can comment on is the subject of bull markets in general. And it would appear that your property markets have been ascendant really for 12 years, which would seem to me that they're becoming long of tooth. But I say that only from a generalist perspective. What happened in North American property markets in the period 1982 to 2000 was that these markets came off a very low recession-inspired base in 1982, and that rents rose fairly rapidly at the same time that the demographic boom of the baby boomers came into the market. And what began to happen probably 10 years before the peak is that rational expectations with regards to property, that is prices that were driven by utility and rent, gave way to irrational expectation, where past performance became a guarantee of future performance. And if you can say in Australia that you've entered the period of time where it's the expectation of future performance that's driving the property market, rather than increasing incomes of buyers or increasing rental income associated with those properties, then one must be pretty careful indeed. The other question that one must ask themselves with regard to the Australian market is whether the demographics that Mr. Dent describing as impacting the U.S. market will be as pronounced in the Australian market. Is your natural birth rate and is your rate of immigration as a consequence of employment opportunities in Australia strong enough that it can overcome the tendency of the baby boomers to downsize in terms of their property investments as they become empty nesters, or as they switch from higher valued property to lower valued property to augment the cash available for their retirements? And in the context of your own markets, all I can say, unfortunately, is I'm not familiar enough with them to offer up an opinion.
No worries, Rick. I'll have to get Mr. Dent on the show, as the majority of Australians have their net worth in property, so it could be a potential disaster waiting to happen. Switching to industry now, Alcoa recently announced that they're shutting down 2 of their aluminium rolling mills, and this is going to affect around 1,000 workers. These shutdowns are becoming more and more frequent because the company simply cannot turn a profit. What do you see as some of the challenges that face Australian industry?
I would say that Australia has 3 challenges. One are rising energy costs, which Australia shouldn't have. In that regard, your government took the rifle, pointed it at their foot, and pulled the trigger. The 3 mines policy in Australia with regards to uranium, and the reticence of Australian federal and state governments not to emphasize Australia's natural advantage in nuclear energy has led to the relatively high prices of energy in Australia relative to other developed markets. The second challenge that you have is a reticence to use your own coal, which could also lower your domestic energy charges. Now, one can say, in defense of your own government, that the commodities boom, in particular the mining boom, which your country has enjoyed in the last 10 years, has meant that the level of energy consumption and the level of economic activity generally in Australia, which has evidenced the best growth of any country in the developed world, has been such that the government could not have foreseen the demand for energy which has occurred in your country over the last 10 years. And some of the decisions that they made with regards to capital investments in energy and their underinvestment in energy is in fact warranted. What makes that conclusion difficult is being now confronted with today's reality, that there aren't more moves afoot in Australia to develop nuclear power and coal in Australia. The second challenge that you have is a wonderful challenge. Yours is a labor-constrained market, and there are very, very, very tight labor markets for skilled workers, the aluminum mill workers notwithstanding. And the real wage inflation in Australia, which has done a wonderful thing for the working man and woman in Australia, is such that on a global basis, you are much less competitive than you would have been in 2002. I remember spending time in both Australia and New Zealand in the period 1998 to 2002. And everything for a global investor or a global consumer in Australia and New Zealand was ridiculously cheap. I'd go into a restaurant in Canberra or a restaurant in Perth, and given what I had eaten and drank with my peers, and of course in Australia the drinking part was always larger than the eating part.
Yeah.
But at any rate, the bill that I got back made me think that I'd gone into the establishment with a mask and a gun, and they were afraid of me.
Yeah.
I was recently in Australia, I believe it was in November of last year, and I had the same experience, but from another point of view. When the server handed me my bill, I looked for their gun, because it seemed to me that the bill that I was paying from a global point of view was extortionate.
Yeah.
So the nature of what's happened in the Australian economy, both good and bad, has made your country, much less competitive in the context of global labor costs. And I guess the third thing that's happened in Australia, it happens in every country that gets rich, is that increasingly your government has become more oriented towards redistribution and more oriented towards regulation. And the capital goods producers, the mining businesses and the processing businesses, see the inclination on the part of the Australian government and Australian society to attack the fixed asset investors by way of royalty or corporate tax or some other way in an attempt to effect a redistribution of income, which is another way of doing in your country what our government has done in my country, which is to declare war on the productive elements of society, the people who save and invest, to redistribute it to the more numerous people who spend. We have a joke in the United States, which I can paraphrase in the Australian context and say, a modern, Western, rich democracy is 4 dingoes and a lamb voting on what's for lunch.
Yeah.
It is always, of course, the less numerous saver that gets eaten by the more numerous spender in democracy.
Jim Rogers has said that in the not too distant future, it's going to be the farmers that are driving the Lamborghinis. Rick, what are your thoughts on investing in agriculture?
I think agriculture is an extraordinary business, but I also think it's far enough off the bottom that one must invest in it with some absolute caution. Were I an Australian investor, what I would be investing in the context of Australian agriculture would be Darling Basin water rights. The Darling, after having 7 or 8 years of drought, has experienced a couple of years of floods. And the consequence of that is that perpetual water rights in the Darling Basin fallen in price by 50%. And I absolutely guarantee you, that Australia hasn't seen its last drought. The Darling Basin is an amazing agricultural province in Australia. It's an amazing agricultural province because of irrigation. And in order for the basin to continue to produce in an agricultural context and also provide water to a rapidly urbanizing Australia, there's going to be more and more and more straws in a diminished sponge. And so from an agricultural investment viewpoint in Australia, focus on the water.
Rick, in regards to specific commodities, what are your thoughts on gold and silver?
Well, certainly with regards to gold and silver, they are currently valued in US dollar terms and benchmarked against the US 10-year Treasury. While I have no near-term outlook, my suspicion is that the immediate past is prologue and they'll continue higher. Longer term, I have much less doubt. The US 10-year Treasury at 2.9% seems to me to be best described by my friend Jim Grant, who called it return-free risk. Return-free risk does not appeal to me as an alternative, and I suspect as a consequence of that, the gold and silver will do well. But I can't tell you when.
What about platinum and palladium?
Certainly platinum and palladium I'm more bullish about than gold and silver, simply because the supply side of platinum and palladium you don't have to worry about. We have less than 1 year's finished supply relative to fabrication demand. The price can go up, the price must go up, so the price will go up.
And uranium?
Same thing. On a global basis, including cost of capital, it takes $70 a pound to make the stuff, and we sell it for $35 a pound. That means that the industry loses $35 a pound and tries to make it up on volume. We have two choices on a global basis. The uranium price goes up or the lights go out. I think the former is much more likely than the latter.
And finally, oil.
Oil, you have a surprising standoff, I think, between supply and demand. Demand has been very weak on a global basis as a consequence of diminished economic growth, but the world is living on supplies that are very, very, very old, with the exception of the United States and Canada, which are using new technologies to unlock previously hard-to-get-at supplies. The wild card in oil and gas is simply geopolitics. The increasing schism, as an example, between Sunni and Shia Islam is expressed physically in a place called the Straits of Hormuz, a 70-kilometer wide gulf between Shia Islam and Sunni Islam. If the current disputes between those two sectors that you see so obviously in Pakistan, Afghanistan, Iraq, and Syria explode into a broader dispute between the Sunni nations of the Arabian Peninsula and Shia, Iran, and the Straits of Hormuz were closed, and I'm not saying it's going to happen, but if it did happen, you would certainly see a doubling of oil prices very quickly.
Rick, for somebody with no investment knowledge whatsoever, where would you suggest is the best place for them to start learning?
Absolute no-brainer. Absolute no-brainer. There is a book called The Intelligent Investor, written by Benjamin Graham. Benjamin Graham is famous as the professor who taught Warren Buffett about investing. So if you measure him by his product, he's damn good. The Intelligent Investor is simply the best investment book that was ever written relative to the effort required to read and understand it. You don't have to buy it. Any good library has it. You can borrow it. You can buy it electronically. You can buy it physically. It doesn't matter which version. It was published, 14 times. Don't get caught up in what version. Buy the book, read the book. When you're done, read it a second time. And if it was easy for you to read, if it was enjoyable for you to read, then buy another book. That book is Securities Analysis, also written by Ben Graham. That is, without qualification, the best investment book that was ever written. But it's not easy to read. If you read The Intelligent Investor and then read Securities Analysis, and if you understand them, and if you employ the methodology taught in those books, you will get rich. But it's not enough merely to read them. You must employ that technology.
If you could go back in time, what advice would you give a 26-year-old Rick Rule?
Well, 26 is particularly topical. I was in my formative years in the last great bull market, the 1970s bull market, and I made an astonishing amount of money for a young guy because I didn't know any better. The advice that I would give a 26-year-old is don't confuse a bull market with brains. A bull market gets progressively riskier and progressively more expensive. And you didn't make the money in your first bull market because you were smart. You made the money in your first bull market because you were lucky. And if you confuse a bull market with brains, you're going to lose all the money that you made plus some, which is precisely what I did when that market came apart. So my advice to myself, God, I wish somebody had given it to me, and I wish I would have been mature enough to listen, is for Christ's sakes, don't confuse a bull market with brains.
Rick, as we're both among the founding members of the new social media publishing platform Liberty.me, I wanted to give you the opportunity to share with my listeners a sneak peek of what Liberty.me is all about.
Liberty.me is important. It is a global freedom, liberty, and individual liberty website that's really geared to how you can live your life more freely. What's important to me is that it's not a nonprofit, it's a for-profit, which means that the people who operate this site have an incentive to deliver good, usable information to individuals because they make money at it. It isn't being done out of the kindness of their heart, although I know them, they're all kind people. It's done because if they provide utility to users, they'll get dirty, filthy, stinky, slimy rich. 2 of the 3 people behind it, by the way, are already dirty, filthy, stinky, slimy rich, which suggests that they've been successful in the past. I think it's probably the single most important social experiment that's going on in the world today, because I think the greatest risk that we face today is, on a global basis, the belief of the mob that coercion is an intelligent way to operate society. The idea that a majority of voters have the absolute right to steal from other people, to constrain other people by regulation. Liberty.me says something very, very, very different. That we have the right to try and persuade other people to our point of view. That we have the right to work to our own ends and to use the product of our labor, be it by way of profit or anything else, in a way that suits ourselves. That collective decisions have to be arrived at on a consensual basis, so that while we have an absolute right, and in fact an affirmative duty to persuade each other, we have no rights to coercion whatsoever. I'm delighted, first of all, that you found Liberty.me. I don't know how that occurred, but it's a wonderful accident. And I'm delighted that you gave me the chance to sort of thump the tub and promote it. I gave $10,000 in their crowdfunding to Liberty.me to make available scholarships to low-income members of Students for Liberty in South Asia. And I have a high degree of confidence that Liberty.me will become a freedom portal and, importantly, a self-publishing platform for liberty-minded people on a global basis. And I think they'll do it very, very quickly.
Before I let you go, Rick, my listeners are going to want to hear more from you and the rest of the team at Sprott. Where can they find you?
It might be useful to you and other people who constitute your audience to know that if you go to our website, www.sprottglobal, you can subscribe to Sprott's Thoughts, which is a 3-time-a-week blog put out by the Sprott organization that has the best opinion, the best paradigm, offered up by all of us at Sprott, including Eric Sprott, Dr. Mark Faber, John Embry, myself, and the other analysts and portfolio managers at Sprott. I absolutely guarantee you'll get your money's worth because it's absolutely free.
Any final thoughts you'd like to share with my listeners, Rick?
No, I think we beat them pretty hard. Remember, the biggest risk is to the right of your left ear and to the left of your right ear. Read those books I talked about, get the blog, Forewarned is Forearmed. And anybody who makes any money, sign up for Liberty.me. Make your life better, make the world better.
Ladies and gentlemen, you've just heard from a natural resource investment legend, Rick Rule from Sprott US Holdings. Rick, thank you so much for joining me for the first episode of the Contrarian Investor Podcast, and I look forward to having you grace us with your presence in the future.
Thanks for the opportunity, Tom. I look forward to it.
Before I let you go, folks, be sure to like my Facebook page and subscribe to my YouTube channel so you can be the first to receive the podcasts as they're released. I'll also include links from today's episode in the video description. Have a great week, guys.